Gas prices hit $4 a gallon on Tuesday, for the first time since 2022. But Nobel laureate Paul Krugman says that number tells less than half the story. The Strait of Hormuz doesn't just carry oil. It carries diesel, jet fuel, fertilizer feedstocks, and the petrochemicals that become everything from milk jugs to children's toys. Iran's blockade has locked out roughly 20% of the world's daily oil and gas supply, and the ripple runs far deeper than what flashes on gas station signs. Diesel prices have climbed $1.70 per gallon, 70% more than the jump in gasoline. Polyethylene, the world's most common plastic, is up 30% since the war began, because 84% of Middle Eastern polyethylene exports move through that strait. Dow CEO warned that petrochemical shortages could fuel inflation through the end of the year, and jet fuel costs for airlines have surged enough that carriers are already revising forward guidance. Moody's Analytics put a name to what this means for the domestic economy. It called the energy shock effectively a tax on U.S. households, one that hits the bottom half of earners far harder than the top. The wealthiest 10% of Americans already account for nearly half of all consumer spending. Low and middle-income households spend a larger share of income on essentials, fuel, food, transport, leaving them with less cushion when those prices spike. Real wages for low-income workers fell 0.3% last year. Savings rates are near historic lows. Americans may have paid an extra $8.4 billion in gasoline alone in the months since the war began, according to a Democratic Joint Economic Committee analysis. The K-shaped economy isn't new, but the Iran war is accelerating its divergence at a moment when the bottom half has almost no buffer left. If the Hormuz closure persists, Moody's warns the shock will meaningfully reduce household purchasing power, and consumer spending, which drives 68% of U.S. GDP, will feel the weight. That same oil shock, however, is rewriting the investment case for an entire sector that the Trump administration had been quietly sidelining. Renewable energy was already breaking records before the war. IRENA, the UN Energy Agency, reported last week that renewables accounted for 85.6% of all new energy capacity installed globally in 2025, and now make up a record 49.4% of the world's total energy capacity. But geopolitical pragmatism is now adding a second engine of demand that has nothing to do with climate policy. Countries that had been slow to move on clean energy are accelerating, not because of ideology, but because the Hormuz blockade exposed how fragile fossil fuel supply chains really are. Southeast Asian governments facing fuel shortages are fast-tracking electrification. Europeans are rushing to install solar panels and heat pumps. IRENA's Director General framed it directly. Countries that invested in the energy transition are weathering this crisis with less economic damage. The iShares Global Clean Energy ETF and the Invesco Solar ETF are both up roughly 54% over the past year, gains built before the war and now reinforced by it. GE Vernova and First Solar have both emerged as primary beneficiaries as institutional capital rotates out of oil-exposed positions and into energy independence plays. The investment thesis has shifted. Renewable energy is no longer primarily a climate argument. It is now a national security argument, and that reframing opens the door to political support from constituencies that previously opposed it. Even within the Trump administration, the logic of energy self-sufficiency aligns with the renewables build-out, even if the ideological framing differs. Two threads run through today's market: a consumer sector being taxed from below by oil, and an energy transition sector being turbocharged from above by geopolitics. The variable that determines which dominates portfolios over the next quarter is the duration of the Hormuz closure. If the strait reopens within weeks, the inflation shock fades before food prices fully transmit, consumer spending recovers, and the K-shaped pressure eases, but the renewables trade loses some of its urgency premium. If the closure persists into May and beyond, the calculus reverses sharply. Diesel prices embed into trucking contracts, fertilizer costs hit grocery shelves by summer, and the Fed faces a stagflation scenario where inflation stays elevated even as growth slows. Fed Governor Williams said this week that he sees risks to both inflation and employment as balanced, careful language that signals the central bank is watching the same fork in the road. Tesla's Q1 delivery miss, 358,023 vehicles against analyst forecasts, down 14% from last quarter, added another layer of complexity as EV demand softens at precisely the moment high gas prices should be an incentive to go electric. That contradiction points to a confidence problem, not just a product problem. The verification benchmark to watch: Brent crude's response to any diplomatic signal out of Hormuz negotiations. A sustained move below $100 would signal the worst-case inflation scenario is off the table. A hold above $110 into next week would confirm the prolonged war scenario and shift the balance firmly toward the renewables and defensive sectors. The leaning today is that the closure extends longer than markets currently price. Iran has captured an estimated $500 billion in windfall revenue from elevated prices, giving Tehran limited incentive to negotiate quickly. But that leaning breaks the moment a credible multilateral coalition, the UK-led group of 40 nations now pressing for Hormuz access, achieves a concrete shipping agreement. If that happens before May, the stagflation scenario becomes the tail risk, not the base case.